All right. And, yeah. Whew, what a day. Yeah, so, some big earnings last night. Tesla, Microsoft, Meta, IBM, probably the big three that I was following. And initially, three out of the four were kind of got clipped pretty hard out of the gate. But Meta, out of all of them, pretty much did nothing, which was perfect for us. And then Tesla gapped down hard out of the gate, and then wake up this morning. I don't watch things till like 6 o'clock. I just don't. I try to unplug as much as possible, but it actually made a comeback. It actually went back up all the way over 400, and now we're sitting at 396. So, whatever. Microsoft continues to be down. That gap down hard. I want to say that was down. Where is it here? Yes. Microsoft was down. It was about 5%. Now it's about 4.25 or so. But IBM was the big mover. That thing was up big. And hey, hats off to call buyers on that. The others, I don't think you're really going to see anything at all unless you sold premium in any of these three, Meta, Tesla, or Microsoft. You're going to be sitting pretty today. So all those trades that I talked about yesterday are all going to be doing pretty well today. And why are they going to be doing well? Well, I'm going to tell you why. No, I'm not. I'm gonna have 5 episodes and then tell you in the very end. So why are they going to do well? And we have to change to option volume. You're going to see a big collapse today in the volatility in all these names. So if we were to look up Tesla, and I wish TradingView had this indicator, but they don't. And I've looked all over for it, and there's been a number of people who've tried to replicate it. It's just not the same. It's this IV rank indicator, and you're going to see, look at Tesla's IV today when it opens. I have a pretty strong feeling that you're going to see where it's actually at 61.6. You're probably going to see this in the 50s today, may even 40s. You're going to see I think you're going to see a pretty decent collapse. This underlying has remained bid volatility-wise for, I would say going on almost 2 months or so. So you're going to see that. And then Meta, same thing. Volatility going into earnings on Meta was 51.2. I think you're going to see that come in as well. I think you're probably going to see that down in the 30s when it opens. And the mighty softy, Mr. Stofties as well. This going into earnings at a 58.4. I think all of these you're going to see. I think you're going to see them all under 50. And that's going to be a very decent collapse, so that if you did sell premium, right, if you did those iron condors or you did those strangles, those options are going to get crushed. because overall, most of these stocks, even though Microsoft was the one that got hit the worst, it didn't get slaughtered, and it didn't move outside the expected move. So you're going to get a good. Now, the outlier here in all of those is going to be IBM. IBM just blew it up. They absolutely blew it out. Expected move was about $27, and I think that's about what you got. I mean, look at that. You can't really script that any better. It was a $27 move in February, and right now you're sitting at 247, and we closed at 228. So pretty close, but still inside, right? Expected move was all the way up to 55 here in February. So still well inside the expected move. So, the problem is, though, if you did sell premium in here, even though this may collapse, I don't know. You're going to have to see how far they crush volatility on this. You could actually squeak out a little gain in this one. This one actually might take till about noon or maybe even the afternoon to kind of boil in. So anyway, looks for the makings of a pretty good day. Again, just realize, we're not killing it here and like banging a tail, but all these trades are probably going to net anywhere between 20 and 40% profit. And look, you try and do that in a day, right? And hey, it doesn't happen all the time. Usually out of 4 trades like that, I'll tell you, 9 times out of 10 during an earnings cycle, it's usually 50-50. Usually half work, half don't. And this is kind of unusual that literally all 4 may actually work, which I don't even think I've ever had happen. There's always one that blows a gasket. It's just usually the nature of the beast. So anyway, that's kind of the story there for yesterday's earnings. And so again, if you did do any of those premium trades, so let's step in and talk about earnings for tonight. Now, we didn't do anything for this morning. All the stocks that reported this morning, they all kind of sucked. So let's go to earnings for tomorrow, or tonight, actually, I should say. That would be after the close. You have Comcast, Dow. What else? Southwest Airlines. Comcast, even though you'd have a high IV rank, this stock is kind of a piece of junk to trade. It really is. And the fact that it even gets a 3-star liquidity rating, I'm actually surprised at that. I would expect it to be worse. But, it might just have volume on the stock. Dow is another one that's coming out. We didn't do any of these. Southwest Airlines, all kind of no-go. And the reason is there wasn't really as much volatility in these, and there really was no juice in the premiums. UPS is probably... I don't even know. I probably may have it psychologically on my no trade list because I've actually don't even recall doing a trade and making money in UPS. I really don't. I know I have some stock here and there. I don't have a lot. I think I might have like 10 or 20 shares laying around because I think I may have bought 20 shares at one point during my option trades. So a lot of times what we do when we trade options, we don't always buy 100 shares, but in order to neutralize like your delta, sometimes you have to buy stock to like almost neutralize your delta. So I know I had done that, but again, this stock is not the most liquid stock. And then you look at the spreads in here and they have earnings coming out. as well here soon. If you look in here, the spreads in here suck. I mean, some of these are like $1 wide, so it's like I don't even want to touch that. So anyway, for tonight, we have another group of biggies for tonight. Basically, Apple. Good volatility in Apple. That drawdown that we had last week in Apple actually pumped a lot of volatility into Apple. So you kind of put Apple on the plate to even trade this earnings cycle because, as of last week with the run that it's had, they pretty much took it off the table for me because there just wasn't any volatility. But now there is. IV rank of near 60 is actually damn good for Apple. That usually doesn't run very high from a volatility perspective. So Apple's going to be in play. Intel, we'll take a look at Intel. Intel's a piece of shit. Let's face it. It's the Cisco of chips now. If anybody's been around long enough knows exactly what I'm talking about. It's just I don't know. I don't even know how this thing is even like a thing. It's kind of a slob. IV rank of 88 is high, but I don't know what you do. What do you do in here? There's really not much. And anyway, we'll get to it, and we'll look at it anyway. So we have Apple, Intel, Baker Hughes. I don't know if we're going to trade that. Visa. We'll take a look at that one. That one can be fun at times. And then as far as tomorrow, right, Friday. So if we're going to do Friday earnings trades, you have to do them Thursday night before the close. Not so much a fan of early morning stuff, but, at times there is things that's set up. So we have like Chevron and Exxon on Friday, and we'll take a look at those. But I don't know if there's going to be much there because there's not really much volatility. So anyway, let's just kick this off here and right into it and talk about Apple. So right now in Apple, in February, which is options we're probably going to do for earnings. And again, if it was not a binary event, I'd be likely looking at March or April. So if I was trading Apple for any other reason, whether it be a technical, I was bullish, I was bearish, I was no-ish, I think it's going to go nowhere, I'd be looking probably in March or April. But since I'm going to be trading a binary type of event, which is going to be earnings this evening, I'm going to look at the closest monthly. I do not do the weeklies. I do not do the weeklies. I just don't. You want to do the weeklies? Go ahead. I don't touch them. The only time I'll do a weekly is every once in a while if I get a hunch about something and I think something's going to do, I'll mess around with a weekly on a very, very binary event or a hunch. Otherwise, I don't touch them. And the reason is I don't touch them is because I think they're a sucker's bet. And the reason I say they're a sucker's bet is because a lot of times they don't have the liquidity as the monthlies do. So anyway, you're going to look at the February monthlies, and right out of the gate, the one standard deviation strangle is a 220. And they just added, it looks like they just added strikes. I don't know why they do this. So it's likely going to be a 220, 260, which is outside the expected move on the upside. Margin is not as horrible as I thought. I mean, look, Apple's another one that's a margin hog. It just is what it is. But a 220, 260 strangle, I think you could likely put this on for about 285, maybe even better, because you're going to get a little bit of volatility pump for the rest of the day today. That's not a bad trade. 75%. Can I say that any more obnoxiously? 75. It sounds like Tony Robbins. But anyway, 75% probability of. I hope I don't sound like Tony Robbins. Then I'd sound like this, and then I'd walk like I have a stick up my ass. And then and we're gonna have a great time. But 75% probability of profit. Decent theta number, not great, but decent. It's almost 20. You're going to bring in 285. You're going to use about $3,000 of buying power. Now, this is actually a really attractive trade if you have stock, meaning that if you have 100 shares or more of Apple, you won't have any hit on this on your buying power because basically your call will essentially be covered. But yeah, this would be the strangle. And then if we would go and cover it, I don't think we're even going to get that much, quite honestly. I thought this would actually be a little bit better, but I don't think it's going to be. I don't know. We'll see. Yeah, $1. You're going to probably be able to get this one for about $1.15. So there's kind of my earnings trade. It's going to be the 220, 215, 260, 265 iron condor. I am not going to suggest you do a wider spread. And the reason is because, look, Apple's been a little tumultuous, right? At times, it will blow out earnings and, this 260 will get blown through like it's not even there. And as well, it can get hit from time to time. So I'm only willing to risk about $300, $380. So with this trade, a 71% probability of profit. Decent theta number for an iron condor at 4. And you can't get more delta neutral than this. It literally is both beta weighted delta and actual delta is literally flat, 0.68. So it is literally delta neutral. And then really all you would need for this is to come in within that range and you're going to be all set for tomorrow. So that's my trade for tomorrow earnings is the 260, 265, 220, 215 iron condor in February. February. All right. And the reason I would not widen this, only because I don't know if I want to take more risk in Apple right now, because I really have no idea how it's going to react. I mean, there's always something in the earnings that make people say, oh, wow, this is great, or, oh, wow, and then it never has anything logically to do with what earnings were, right? So, and then just seeing the way things have panned out with Meta, Tesla, Microsoft, I just kind of feel like it's probably better off not to take on any more risk. So there's Apple for tonight. I don't really see any other way to really slice and dice that one because, I mean, you could skew it if you wanted to, if you kind of had a feeling that, Apple was going to have a bit disappointing and maybe they were going to, you could skew it and move this down to like, say, a 215, 210, and then move your call down to a 255, 260. I just don't, and I don't like it because you're not even getting really paid for that. So it's actually in the wheelhouse at the one standard. So there's a reason why the one standard deviation is where we usually land because that's usually where you get the best juice. So anyway, so that's the one. I'm not even going to mess with it. So that's it, about 115. It says 108 now, but I think you probably, by the end of today, you'll definitely be able to get this for 115, I think. And if you can't, don't force it. I always tell people, don't force it. Put it out there. Let the markets come to you. Don't chase it. Don't feel like it. And if it goes by and it doesn't get filled, well, so what? Just go on and have a good night. That's it. Intel. I don't know about the Intel. I think really it has to do more with, I don't believe there's much you can do. At an IV rank of 88 is high, number one. So it kind of takes buying options off the table, because I don't want to own options when volatility is this high, right? That's just asking for problems. And so what can you really do in here? The only thing you can really do of any consequence would be to, maybe sell a slightly in the money put spread or something, or just sell a put. You don't even need to sell a spread. Because look, if I sell the 20, if I sell like almost a little out of the money, with the inkling like, hey, look, if I own the stock at 20, which I don't, right? So if I own the stock at, my cost basis would be $20 less my premium, right? If I get put the stock. So, and I'm only going to use $400 worth of buying power. Sell the 20 put in February. It's almost equivalent to owning 48 shares of stock. I mean, it's really all I can see that, and I might even do that just for shits and giggles, because I'm really not even risking anything. And so, I mean, that's the only thing I can see you could really do here. Sell the 20 put naked. Sell the 20 put naked. You end up owning the stock at about 1945 would be your cost basis. If you got put the stock, it would be about 1945 or 1845. So, I mean, you have to ask yourself, is that such a bad price to own Intel here? I don't know. I'm sure the people who owned it at 34 thought it wasn't that bad either. But, who knows with this piece of shit. I guess it's shown some pretty decent support at around 18 for a while, since August. So if you go back to August, it's shown some pretty good support at 18. So having a cost basis of 1845. So actually, the more I look at this, like just from a technical point of view, volatility point of view, sell the 20 puts. Sell the 20 puts naked. Don't have to cover it, because the margin's nothing. So you could sell the naked put. And just remember, a naked put is equal to buying the stock. Right? It's equal. It's as equal as owning stock. As you can see, I'm getting 48 deltas. So I'm almost at 50 shares of Intel. I got a 62% probability of profit. I also got 22 days. So even if earnings suck, as long as the price of Intel stays above 1845, I'm in good shape with this. I'm in the good. Yeah, so that's what you do in Intel. Sell the 20 put. That's it. I really can't see doing anything else. I mean, if you want to get creative, you could buy the stock and sell the 20 call. And that also puts your cost basis at 1839. But in this case, if you bought the stock and sold the call, so did like a covered call, right out of the gate, you do the covered call, you're wanting this to get called away. That's your goal, right? You want it to get called away at 20. You make your $150 in 20 days, and you go off and have a nice life. Because if it doesn't get called away, and let's say it, by the time expiry rolls around, Intel's below 20. All right, hey, great. Your call expires and you keep the premium, you're also going to need to probably roll it into March, which overall isn't a bad play, but then you're going to be stuck in Intel and owning Intel stock. And if you want to be stuck, that's fine. I don't know if I want to be stuck in Intel longer than February. So that's why, but I'm just giving you an option here. Like, if you don't feel comfortable selling the put, do the 20 covered call right out of the gate. And if you don't already own Intel, or if you own Intel already, just sell the 20 put, whatever. But what I'm saying is I think that those are like the only two options is to get delta positive in this. You really can't get any more negative because you're not getting paid for it. You're not getting paid to bring on negative delta, in my opinion, for Intel. So either sell the 20 put or do the 20 covered call. Cost basis is about the same. It's almost exactly the same, and it's almost the same amount of deltas. It literally is. It's like 48 deltas either way. So pretty cool, right? How that works. So anyway, that's it. Intel. Yeah. All right. Now, Visa. Now, Visa can be a mixed bag. It can be good. It can be bad. The markets in here are not the greatest. I will tell you that. They are a little frothy, and as well, there's not generally a ton of open interest in here. I'm just going to look at it for exercise purposes. I don't think I'm going to do a trade in it because it's a little difficult to trade. And as you can see here, look, there's not for a big stock like Visa, $500, $400, whatever, $333. You look up and down the option chain, you don't really see what I call elephant prints here at all, especially in February on an earnings play. You see nothing. I mean, look at this. You got some expiries. Now, I know a lot of these were probably added, like these $2.50 wide ones were added, so there's not really a lot there. But just look at the bigger strikes. This is freaking lousy. I mean, 1,400 contracts, 3,000 contracts. I would expect these to be like 10s and 20s. Now look at the puts. Like literally no open interest on the put side at all. Like nothing. It's horrible. So that is why, I just as an example, why you got to watch liquidity, because the stock can have all the characteristics, all the great things that you want. Sometimes it is just not a good options play. And the reason is right, liquidity moves stocks, right? You want things that are liquid. You want things that you can get into as easy as you can get out. This one, I've always had a problem getting out of stuff. And it's been frustrating. And so anyway, just as an example, look, they got earnings. You would think that there would be tons of open interest over here. They got earnings tonight. There's nothing. No, it's like nobody's interested. Now, look, it's not that there's nobody interested. I should say there's just no elephant prints here. Like I would have expected to see, 10 and 20,000s up and down the chain here, at least in a few spots. The only place that I see any kind of an elephant print is at 355 on the calls. Has an 11K open interest. So, yeah. I mean, there you have it. So that one's kind of off the table then. Because I'm not willing to risk anything on that. So that one's the last one for tonight. So we're not going to play that one. And then let's look at Chevron for tomorrow. Overall, Chevron, as you can see here, doesn't usually run hot when it comes to volatility. It's most of the time it's not a very good stock to trade on earnings. I do, however, like this space only because it does have what I think is a lot of potential going forward. right? And without being political, and you can be on any side of the political scheme, I really don't give a fuck. But you have an administration that's going to be very cooperative with the oil industry, at least so we hear, right? So anyway, so there seems to be a lot of potential here, and these stocks really have not gone anywhere, right? This is this year, highs of 167, lows of 137. So basically a $30 range over the last 12 months or so. These things haven't gone anywhere. There could be a possibility of these things maybe getting ready to run. So let's take a look at, it looks like the 1 standard D is going to give us a where did they come up with 149? Whoa, right? What, 149? Where the hell did that come from? Yeah, I'm looking here, and this one doesn't look like this is going to be, I don't think this is going to be any good. There's really not enough juice in here. No, there's no juice in here at all. I would, however, here's one that I'd like to maybe take a little twist on. I'd actually go out to April here. I would go out to April. And you saw from the chart, seesaw. I would look to sell a little put spread. I like the 145, 135 put spread. I like that one. So the 145, 135 put spread. Now, look, it might not be attractive to a lot of folks, but I think I'll be able to put this on for $1.50. This is out in April. It's a $10 wide. I don't have any positions on in Chevron. I have stock, but I don't. I've had it longer than probably most of you watching here have been alive. So I've had it a long time. And, I like that because, look, we looked at the bottom was about 130. Top was 160. It's kind of in that range. I could sell this for $1.50. I kind of like it. Gives me a little bit of exposure to Chevron. And so I'm actually going to put that. And the reason I want to put that on now is kind of, right, increased volatility in Chevron right now with earnings. So that's what I'm going to do today is add a little position on in Chevron, the 145, 135 put spread. All right, and then last but not least is going to be Exxon. Not a lot of volatility in here at all. Don't know if there's really going to be much you can do. As well. I might do something similar in Exxon as I'm doing in Chevron. Yeah, there's nothing to do in here. You can't do much. Although the markets are decent, they're okay. They're not great. They're decent. And you have a lot of open interest up and down the chain here. The 115s have 24,000 contracts. This is what you want to see when you talk about option plays. I just don't think I want to. I just don't think I want to risk use $1,500 to make $1.30 on a strangle. It's not interesting to me at all. And so I would probably do the same thing in Exxon as I would in Chevron. I would buy. Let me take a look at the chart because these stocks again they've been in a range for a while. I like the 105. I would definitely do the 105. Looks like again I'm trying to mix technicals with a little volatility as well. It looks like we had decent support at 105. Exxon's not really a mover overall. I think you could sell the 105 You could either do the 105, 110, do a little bit of risk for $1.35. I actually really like that trade. That's a nice little cheap trade, especially for a lot of folks who aren't completely savvy in options. And with this trade, you're only going to use $300, $360 of buying power. You got a 67% probability of profit. It's almost like getting 14 shares of Exxon. And you're going to do that for $1.35. And then you saw the chart. Seen the chart, right? A lot of support at around 104, 105. So, technically it makes sense as well. And I like that one. Actually like that better than the Chevron trade. In fact, I would even scratch the Chevron. Looking at this, I think Exxon's a better play. So scratch fucking Chevron. Screw that one. Oh, I dropped the F-bomb. I'm going to get censored now. But yeah, scratch Chevron and do Exxon. Do the 105, 100. And this one you can actually take on. If you take on a little bit more risk, you're going to get paid pretty decently. This one you could do for probably $2.15. And that's going to give you 24 deltas. This one's actually a little better if you want to take on a little more risk. So either one, the 105, 100 or the 105.95, which is 10 wide, right? Depending on your risk tolerance, the 105.95 is going to run you about $800 worth of buying power, $785. You're going to bring in $215. That's like trading 24 shares of stock. And you basically be synthetically long Exxon. And either one to me is actually, if you don't have the capital and then you have a little smaller account, do the 105, 100. Now, I think the nice thing about Exxon is I think they have, and I haven't traded Exxon in a while. No, I thought for some reason, maybe in the shorter month, in the February, they have dollar wides. Yeah. In the February they have dollar wides. I don't think I would do. Yeah, I wouldn't do February. I'll go out to April. Because volatility is not extremely high in here. Volatility overall never really runs extremely high, as you can see. Averages about where it's at right now. So. That's what it is. Look, there's been a few times where it's run and it's actually spiked in volatility, but for the most part, it does hover around 30s. It's not a very volatile stock. So, so that's the trade for me for that. And then now that's it for the earnings trades. And then next week, we have a bunch of good ones like Palantir, Pfizer, PayPal, Merck, Juniper Networks, AMD, which has been a slob of late, Google, Chipotle. Fucking hate that place. And look, I don't want to diss on it. It's just like, come on, I'm into plop and slops. Come on. Pancheros is better. So anyway, so next week. And so that's it, really, as far as earnings. I think we have some news. And then yesterday with the Federal Reserve, that was big fat nothing, right? He obviously didn't say anything. And who cares? Who cares? He's going to say whatever he has to say. As far as numbers today, I don't know, core PCI, blah, 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 jobless claim. I don't know. I don't see any of this stuff being anything that's going to move anything around. It's all about earnings right now, folks. It is all about earnings. Yeah, and that's it. That's all I see. And so there you have it. Good luck today. Again, with all these trades, the Apple, Iron Condor, the Intel, right, with the covered call, the Exxon, all of these trades, you need to start putting them on around 3:30 now. Depending on where I don't know where you are, West Coast, East Coast. But, half hour, half hour before the close, you need to start putting these trades on. And you also need, I was telling somebody yesterday, they were asking me like, oh, well, for example, Microsoft was actually, it was Microsoft or Meta? I think it was Meta was up $6. I was like, yeah, you have to adjust it a little bit. You can't, like, I'm doing this pre-market. So whatever you're doing, you have to look, like if you're going to do these, you have to adjust it. So and the way you do it, because they're like, well, how do I know? And how do I know how to adjust? I said, it's pretty easy. Well, I don't know what platform you're using. I hope you're not using like Robinhood. But anyway, if you are, just do yourself a favor. I don't get paid from Tasty Trade. I do not get paid. I get nothing. I have a referral link. I don't even use it because I don't care. I said, what are they going to give me? 50 fucking cents for referring somebody over? I don't care. You know what I mean? But you can open an account with them and get access to the platform for free. You don't have to have an account. You could go through all the motions and say, yeah, I'm going to open an account and do all the shit. And then it says your account's not funded. You could still get access to the platform. You don't have to trade. And then if you like it, you could put money in it. You can put $500. You don't even need a lot of money. You can put friggin' $500 in it, just like you do in your Robinhood account. But anyway, get this platform, and then how do you adjust, right? The lines are right here. This line on the options chain. This is why Tasty Trade's so good for options. You have this line. That's the one standard deviation. And this is the one standard deviation call on the high side. This brown marker in the middle is the expected move in that month. That's why that's there. And so make sure when you're doing your earnings trades that your wings, right, your short wings are always outside either the expected move or near or somewhere around where the one standard deviation is. And that's how you adjust. And you don't even have to do the thinking on Tasty Trade because they do it for you. Excuse me. So that's kind of why I use it, and it's actually pretty good. It's not more than pretty good. It is the best options trading platform out there. Hands down, right? You have the graphical interface. So if you want to see things graphically, you have this, right? So when we did our trade, and I don't want to make this a sales pitch for Tasty Trade, but this is how you adjust, right? So look, we had our trade on, right? The 220, 215, 260, 265. We went over to the curve. They have the little thing. Do you want to see it on the curve? Here's the curve. And it shows you graphically. Like, look, here's the red zone where you lose money. Here's the green zone where you make money. If you want to adjust, you just move these. So if the price moves, you just move your strikes. If it moves up, you move your strikes up. You move your calls up, you move your puts up. If the price goes down, you move your puts down, you move your calls down. Simple. That's it. Very, very interesting. Now, if you really want to see, there's all kinds of analyses here that it does. And the reason I don't put this up because this analyzes your holdings. So it includes whatever trades you're doing plus whatever holdings. Now, I happen to be long Apple stock. So when I put on the analysis tab, it looks to analyze my holdings overall, right? It shows that I'm skewed to the upside. Why? Because I own stock. But if I take this off, this just shows me this trade. All right, got it? Pretty cool stuff. Pretty cool stuff, right? So if I want to analyze the trade, the specific trade, I just leave it here. If I want to analyze how this trade impacts my overall position in that stock, I hit the analysis, and that I could say that tab, and that gives me how this trade impacts my overall position in that stock. Great stuff, man. It is absolutely great stuff. So anyway, there you have it. So that's how you do it, and you have to adjust. You have to be fluid. The word is fluid when you do this stuff. You have to be fluid. And last but not least, just accept that there's going to be quite a few of these that just don't work. That's just what happens. No one has a 75 or 80% success rate. They don't. Because if they did, they would not be on social media. They wouldn't be selling a course. And they wouldn't be out every day marketing themselves doing that. Because honestly, if you did, you wouldn't have to, folks. I've been doing this long enough to where if someone had that good of a track record, they would need to do no marketing at all. This is a very small business and word would get out so fast, you would not have to do a stitch of marketing. All right, so there you have it. That's all I got. I have to go back to my real job. So good luck, and we'll see how these ones work out. Apple, Intel, and Exxon for tomorrow. Have a good one.